let me just say what a pleasure it is to see the IPF in such rude health, both in terms of the papers, but also in terms of the attendance, the very high quality attendance, which speaks to the reputation that it has rightly acquired. Because of the hard stop and the fact that we are actually starting at 2 rather than 1:45, I'll limit my introductory remarks. I will try and be strict on a time allocation. I had granted a couple of minutes from my time to each of the discussants. The clock may still say 10 minutes, but I'll certainly give them a time check at 10 and kind of a close down at 12 to allow enough time for discussion. And I think you would all agree that in all the panels and papers up till now, the discussion has been extremely high quality, and we have as much to learn from the participants as we do from the presenters. And let me just discipline myself, because that's always the risk that the chair prattles on. Okay, so the topic is India's foreign reserves and global risk. It's a dense paper, it's a technical paper, it's a very well documented paper, and so my appreciation to the authors in putting so much time into what remains a draft paper. And I would say that when we're talking about papers, the purpose of these interactions is to provide comments that can be used in finalizing the paper. In that sense, there's a difference between the paper discussions, of which there are 4, and the panels. Now, I have an interest in these issues, and what I would essentially say is that one can be thinking about the discussion in terms of the world as it is, fortunately or unfortunately, and then, since we've had a discussion, particularly today, of the world of 2047, what is the world that India would like to see, that would assist India's own economic transformation and development. Let me just start with the world as it is. Those of you who are here, I think it was last year that Ellen Ray gave Bery was here then, and I was privileged to chair Ellen's session. And it was analytic work on, as it were, the evidence for a global financial cycle. Many of you would know that she's done a lot of work on that. But I think the interesting discussion was, so if the global financial cycle is a reality, how should countries cope with it? And as I recall, one of her proposals was to complement monetary policy with macro-pru regulation. So you had 2 instruments, a monetary policy instrument and a capital flow instrument, or a financial cycle. And I would say that the discussion here is part and parcel of that, which is that there is such a thing as a global financial cycle. Countries have to insulate themselves from it, and reserves build-up is one way of doing that. I would make 2 or 3 points about the world as it is before moving on to, what India should hope for going forward. The first is, and I think the documentation in the paper substantiates that, is that the big build-up of reserves, at least in India and possibly in the rest of Asia, was an outcome of the global financial crisis of 1998. It so happened that a former chair, the predecessor of Nandan Nilekani of NCAER, Bimal Jalan, was the governor of the Reserve Bank of India while being board chair here. And frankly, when he started to pile away reserves, it all seemed terribly countercultural because, on the whole, the feeling was that there was a global financial safety net, and why would you want to salt away your reserves? But he was a practical man, and I think that India and a lot of other Asian countries basically decided that they had to self-insure, and this paper is going to talk about the story since then. Now, I also want to invoke some of the discussion when I worked on Latin America, where people like Mike Dooley, David Focas-Landau, and Peter Garber used to argue that actually reserves are a bit of a honeypot to trigger speculative attacks, and that you don't want to get into a fight with the markets, which is one reason why M2 is one of the, I think, normative indicators for reserves in the fund. But what that then means is that if you're accumulating reserves, you're more or less locked into capital controls if you don't want to be subject to speculative attacks. There's also a reference in the paper to various motives for accumulating reserves, including mercantilist motivations. And Sujit Bhalla, who was associated with NCAER for a long time, wrote this book, Devaluing to Prosperity. I think for the outside world to know what is precautionary intervention, what is mercantilist intervention, is not all that easy, and indeed is now being looked at quite hard by the IMF, by the US authorities in terms of, if you like, intervention. So all of these things belong in a piece, a sense of, what the exchange rate is going to be, what the capital, what the restrictions on the capital account are, and self-insurance. Okay. So this matters for India, and Bery and I have had a separate discussion on this, because if in financing climate change or whatever, India wants to increase the scale of its current account deficit, then is that safe, and do you have to salt away reserves for that? Just a word on the world as we would like it to be, which is that this amount of self-insurance is a waste of national savings, and there was a stage when Monte Carlo was in my job when he talked about maybe using these reserves for backing investment, I think I don't fully understand how it is that the advanced economies have what it has taken in terms of financial markets for advanced economies other than Japan, essentially to have dispensed with reserves. So as we've talked all morning about, the transition from low income to middle income, I think there's a similar trajectory that's going to be followed in terms of insulating yourself from the global financial cycle. So I've taken longer than I should, and without further ado, let me ask the first speaker to make their intervention. And is that you, Chetan?
Yeah.
Yeah, okay, fine, good. You've been assigned about 15 minutes each, you and Ken.
Great. Well, thank you, Suman, and thank you, Poonam, for inviting us to write this paper. I think this conversation started last year, and Ken and I have been plugging away at it more intensely over the last few months. So the motivation for this paper is to think about what monetary policy committees ask, what central bank governors ask, and what the RBI governor asks, which is, what should be the size of India's foreign exchange reserves? Should it be 400 billion, 600 billion, 700 billion? And Manmohan Singh, 4 or 5 years later, after the 1991 crisis, pointed out that the balance of payments crisis would have not been as severe if India had more foreign exchange reserves at that point. Our foreign exchange reserves, which were about $1 billion, covered about 2 weeks of imports in mid-1991. And they were much higher in the 80s and even in the late 70s. And the late 70s was a low growth phase in India. And then Bimal Jalan also, I think, gave a speech in Missouri, I think somewhere around the time of the Asian financial crisis or a little after, saying that the precautionary motive was needed and we needed to self-insure and that India needed to accumulate reserves. So it's really after the 1991 crisis that the Reserve Bank of India starts to increase its stock of reserves because it feels that, it's the best defense against spillovers and unwarranted depreciations. But what we're trying to do in this paper is not arrive at a specific point estimate for what that number should be. That's not the goal of this paper. The goal of the paper is to think about what should determine, or the forces that should determine what the optimal level of reserves are on the margin, right? So that's what we're going to do. We're not going to say, the takeaway from this is not that we need 700 or 800, but what we are talking about are some of the benefits and some of the costs of the current reserve accumulation policy. So that's kind of where our point of departure with the policy discussion is. Now, just for a backdrop over here, so this is a graph of foreign reserves for India. We don't publicly know how diversified these foreign reserves are. We assume that there's enough liquid foreign reserves for the Reserve Bank of India to intervene in the foreign exchange market, but it's broadly divided into foreign currency assets, gold. Gold is about 8.1% of reserves as of March 2024. SDR plus the reserve tranche is about 3.5% of reserves. SDRs are not traded privately, so there's less of an incentive for the central bank to hold a lot of them. And the reserve tranche is essentially proportional to the quota of the country's quota in the IMF. So SDR plus the reserve tranche as of March 2024 is about 3.5% of reserves. And the annually compounded growth rate of nominal reserves since 1991 is about 16%. So it's fairly large. And so this is kind of going back to what I was just saying. There's been a strong precautionary motive and the idea that, high reserve countries suffer less when they are hit with major shocks are all kind of, is the kind of thinking that is going behind increasing these reserves. And this graph just puts India's reserve accumulation into context. So India's reserves started, central bank governors started talking about, RBI governors started talking about increasing them after the BOP crisis in 1991, and as Suman mentioned, after the Asian financial crisis in 1997. But in comparator Asian economies, you see a similar trend. China's on the vertical axis on the right-hand side, and everybody else is on the left-hand side. China's the obvious outlier. So its foreign exchange reserves are roughly 3.2 trillion. But what's interesting here is that India's gradient in the last few years in the run-up to COVID has been quite steep. So you can't compare the levels of India and China, but you can compare the gradients. The gradients in India is actually quite steeper than even the other, mostly the other Asian economies. And for China, it's kind of flattened out. And the source of this is the World Bank database. So everybody is kind of doing something similar. Now, one ratio that's interesting is the ratio of reserves to GDP. And here what we do is we grab the end of quarter dollar foreign exchange reserves, which are available on the RBI website. So that's the stock that's accumulated to that point, end of March, end of June, and so on. And then we use the quarterly GDP in rupees and IFS. We convert that into dollars using the nominal exchange rate, so we get a dollar denominator for GDP. But when you look at the ratio of reserves to GDP, you see something interesting. You see that around 7-8, so there's this increase in reserves in the period of high capital inflows around 2003 and 2008, and there was a discussion there about whether the Reserve Bank of India had enough bonds to sterilize these inflows, and then it realized it didn't. It issued market stabilization scheme bonds and so on. But that was a period in which, the Reserve Bank of India accumulated reserves. And then you see a somewhat flattening out more or less till COVID. And COVID in 2020, 2021, and 2022 up to March, I think the spot and forward purchases of foreign reserves by the RBI were of the order of about $180 billion. So as a ratio of GDP, that goes up in the numerator, and then of course GDP tanks in 2021 and then corrects. So you see this big dip up, kind of down in GDP, but in the ratio you see it blowing up, partly because reserve accumulation has gone up and GDP has gone down. But it's flat in the middle, and what's interesting here, and I don't want to say this too forcefully, maybe somewhat tentatively, is that Calvo has some earlier work suggesting that the optimal reserve ratio is about 26% of GDP. Of course, that's contingent on a bunch of things, but it is interesting to see that flattening out happens at around 20% of GDP. And there's no discussion of this in the Reserve Bank of India, certainly that I'm privy to, but I was privy to, but it is interesting that it has flattened out, even though in nominal terms, of course, foreign exchange reserves have increased. Now, the IMF has a variety of measures which it advises countries to follow in terms of its reserve accumulation. So this is the short-term external debt. So short-term debt is less than a year, based on original maturity, not residual maturity to reserves. And this ranges between about 15% in 2006, goes to about 30%. And there's a well-known Greenspan-Guidati rule that says that the ratio of reserves to short-term external debt liability that makes an economy vulnerable to financial crisis should be about, that ratio should be at least 100%. And over here, based on data that we have, we see that external debt payments due within 12 months at the end of March 23 were 44% of reserves, so that's about 200%, 2x. And the original short-term debt at the end of March 23 was 22.2% of reserves, which is about 4x. So we satisfy the Greenspan-Guidati rule. Another metric that is put out, and in the Indian case, what we observe is that the rupee tends to depreciate when reserves cannot cover 7 months of imports. It's just an experience that suggests that. So that if you look at the 2011, so these are factors of 3. So when the blue line hits 5, that means that reserves are covering 15 months of imports and so on. But if you look at around 2011, and it's about 3, so that's about 9 months of imports. And 2011, 2013 was, of course, the taper tantrum. 2011 was the period after the great financial crisis when we had high inflation. And then 2018-19 was the NBFC, or the shadow banking crisis. Those are all episodes where the Indian rupee depreciated. And the import cover also fell. So, but we are comfortably above this metric as well. So we satisfy the ratio of reserves to 3-month imports well. And then finally, in terms of the third metric that the IMF suggests that countries should follow is reserves to broad money. And here, what we see is that what this measures is the potential demand for foreign assets by domestic sources. And I think the benchmark here is about 20%, but we are above it. And another way to look at this graph is to say that if there's more money floating around in the economy, there's more M3, and a large chunk of that is deposits, then the potential for a bank run, if it does happen, is high, and therefore you need foreign reserves as a source of safe assets, if you want to think of it that way. So these are measures that the IMF advises EMEs and other countries as well to satisfy, and India satisfies them comfortably. Okay, so going back to what I was saying originally about the precautionary demand for reserves, so what I'll do in the next few slides is plot out portfolio inflows. And in this paper, we're just going to focus on inflows. We're not concerned with resident outflows, either sales or purchases. We're going to be consistent with the literature that argues that portfolio inflows have push and pull factors, and and therefore those are, for financial stability considerations, that's the right kind of metric to look at in terms of capital flight or capital at risk. So here, let me just also point out very quickly that based on not work that we have done, but if you, based on some recent work that the ECB has done, that median flows, and this is all flows, so this is portfolio, FDI, banking, tends to be about 4% of GDP for comparator EME countries. FDI and FPI inflows, and this is not banking flows, are about 2.5% of GDP. Debt inflows in India are about 0.5% of GDP. And the pattern of capital flows in India has remained relatively stable, at least until COVID. FDI is approximately half of inflows, and portfolio flows are another 30%. Out of that 30%, equity is 60%, and debt is about 30%. And the rest is banking flows. So what we want to ask is, what do these flows look like? So this graph is based on the OECD monthly capital flow data set. So these are dollar values of portfolio debt, equity, and FDI. And what we have here are, on the black line, are foreign portfolio inflows. So these are non-resident purchases of Indian assets, right, and non-resident sales of Indian assets. So the way it works is that when there's an increase in the economy's external liabilities, in other words, non-residents buy Indian assets, that is recorded as a plus, and when there's a retrenchment, it's recorded as a negative. And when residents buy foreign assets, that's an increase in the assets by the economy, so that's recorded as a plus, and when they retrench, it's recorded as a negative. So the point we want to make in this graph is while there are big swings in the black line, which are foreign portfolio inflows, and these are all inflows, not just portfolio inflows, but FDI and banking plus portfolio debt and equity, there's relatively little variation in the domestic portfolio outflows. So the variable of interest for us is going to be the black line. We're not going to be looking at domestic portfolio outflows. We're really going to be looking at gross capital inflows, which are net flows from non-residents. And then consistent with Forbes and Warnock, we're going to do our regression analysis based on these gross capital inflows, although they do use net capital flows as well. So net would just basically be the foreign portfolio inflows minus the domestic portfolio outflows. So it's a bit like a diff and diff, because you have minuses and pluses in both the liabilities, and then you have the minuses and plus in the asset accumulation. So the difference between those is the net. But we're just focusing on foreign portfolio inflows. And the takeaway from this graph is that we see that there's much more variation in the black line than in the red line, and so we want to focus on the big swings. And of course, here in the GFC, you see around the high inflation period following the GFC, huge outflows in foreign portfolio, debt, equity, and so on. And then it also happens around COVID in 2019-20. Around demonetization, it's relatively less. Going back to the components of portfolio inflows, FDI also tends to be, am I running out of time?
Well, you're eating into Ken's time.
I've got 15 minutes, right?
Yeah. So another 2 minutes.
How much have I done? I've done...
this is down from 30, right?
I've got 2 more minutes. Is that right?
Well, let's recalibrate.
Okay. So now, so FDI is relatively stable. So we take FDI out of the data. And then looking at portfolio inflows versus FDI inflows, portfolio inflows are also much more volatile compared to FDI inflows. So we're focusing on portfolio inflows and not on FDI inflows. And then portfolio debt and equity inflows. So equity inflows are typically a much higher factor than debt inflows in India. Some episodes it's about 15, 16x, but it is a high multiple of debt flows. And but typically when there are equity outflows, there are also debt outflows, and when there are equity inflows, there are also debt inflows. So there's some clustering in this data because of the co-movement in both of these types of variables. So since I've been given a time constraint, so let me just finish up 2 more slides, and then I'll hand over to Ken. And since the title of our paper has global risk in it, so this just plots commonly used measure of global uncertainty, which is the CBO VIX, and then these are the implied volatility options reported by Bloomberg. And what you see here around the GFC, around 2008, 2009, you see both the local proxy for uncertainty, as well as the global proxy for the light blue and the dark blue line in concordance. Around 1314, you see the black blue line being more volatile, and that was because of the taper tantrum, which affected the fragile five more than the broader world economy. And then in COVID, of course, you see a reversal. You see more volatility in the world compared to India, although you do see more volatility in India. But you see the light blue line being much higher in terms of the VIX compared to the implied volatility by Bloomberg. And this just gives you the fraction of reserves that were used up across various crisis periods and also depreciation episodes. So 2011 and 13 were episodes where there was a depreciation in the rupee, as well as 2018, and these range from anywhere from 0.5 to about 5.2% of reserves. And this just finally to end gives you a sense of course, sterilization happens and all the time, but this gives you the percentage of GDP. The foreign exchange intervention is a percentage of GDP based on those sterilization events, and they're fairly high when you look at the run-up to 2005 to about 2008. Okay, so I'll stop there and hand over to Ken. Thank you.
Okay, I have this slide here, I believe, already. So do I need to click something? Thank you. So what we want to talk about is the insurance benefits, and that's where our focus started on, which was self-insurance and precautionary reserves. So the insurance benefits of reserves, however, may go well beyond providing a buffer stock of liquid assets, as we say here, right, to counter exogenous shocks. The idea is that we have reserve, right, formulas, for example, the IMF uses in the wake of the long wake of the East Asian financial crisis. We saw people argue quite a bit, I was one of them, about building up insurance, self-insurance measures, including reserves as well as macroprudential measures and capital control measures. That became a very vigorous literature, but within about 4 or 5 years, it turned to a literature is, have they built up too many reserves? Did they overdo it? And that's what Chetan showed you. Now, the question comes up for us then is that once you have a large stock of reserves by some of those ratios, what we want to know is, do there continue to be benefits from those reserves? Benefits from those reserves, for example, in financial stability, and maybe perhaps some additional benefits from those reserves that might lower the costs of reserves, the opportunity cost of reserves. So that's what we're going to look at in the empirical work. There are other uses of reserves, but they don't concern sort of the sense of how big a stock ought to be, a huge stock ought to be. So rather than our thinking about looking at a formula, maybe coming up with a better one, this wasn't quite the right forum for generating a stochastic formulas, might be more interesting. We focused instead on that question of what are some of those benefits and why might they continue to come when you already thought you had plenty of reserves. So the idea here is that the level of reserves might affect the magnitude of portfolio capital outflows, and that's what we're going to focus on first, okay? We're going to have global financial shocks. We're also going to look at possibilities of policy shocks. We're going to report the results that we got, okay? Now, the idea is that accumulating reserves against large inflows may influence those inflows, right? So what we're interested in that is that they might affect, okay, investor expectations. The endogeneity then of capital inflows is the first thing I'm going to look at. We'll do that in the next slide, if I get the next slide here. Okay, so we're going to ask that question, for example, of do additions to reserves reduce the risk of sudden capital outflows in response to shocks? That is the lower tail of capital inflows, okay, with the gross data that Chetan described. We're going to consider that question by estimating the effect of reserve stocks on the reversals of gross foreign inflows, right, that are when in relation to, right, global financial shocks or policy shocks. Okay, we're going to use quantile regressions doing that. okay? And we're adopting an approach that's recent to the literature, okay? The approach that we adopt is due to Ratna Sahai, Gaston Gelos, and other co-authors, and they, after some time, published their paper that applies the idea, the method, from capital at risk analysis to looking at capital flows, okay? Their focus in that paper, it's a broad paper, of course, but one of their focuses in the paper is to look at the interaction between policy shocks and policies, okay? So we're going to take that part of it, okay? You also, of course, can get from that approach, you can get an estimation of the flows at risk, the title of the paper. The flows at risk will be that lower tail, right, for us, of capital inflows, okay? Because of that small and constrained and very low variance in capital outflows, that is purchases of foreign assets by domestic residents, we leave that off, which of course you didn't. We also, I should note, they do a panel study, so we're looking at one country. Well, somebody had already done that as well, even though there's almost no literature using this. This is, as I said, a very new literature. The country study that we know about, right? It's by Michael Patra and co-authors at the RBI. So they immediately used that method to estimate the size of extreme net capital outflows, not gross flows, but it doesn't much matter, for India, okay? But their analysis focuses on estimating sort of the amount of capital flows that are at risk that you need to hold reserves against. And so that's a sense of we're going to hold reserves, and those are the reserves that we can use up, okay, to meet a capital flow. And that sort of suggests maybe this is a lower bound on the amount of reserves you have. Well, the lower bound on the amount of reserves you have is what the Greenspan-Goudati rule tells you also, and it's bounded by, these are all of the possible flows if you took residual maturity. Okay, that's fine, okay. Our argument might be, even though India's already surpassed that level, is there may be marginal benefits, so I'll move on to that quickly here. Okay, so that's the idea we're going to do. I should mention that, of course, since you respond with reserves and a variety of policies, that you do, of course, have a problem interpreting what those capital flows at the extreme level actually measure then, in terms of risk. They're polluted. Okay. The dependent variables that we're going to use are the foreign portfolio debt and equity inflows from the OECD monthly capital flows data set. We're going to sum them together, and we're going to look at them separately as appropriate. The quantile regression estimates estimate the effect of marginal reserves on foreign portfolio inflows and how those reserves interact with external shocks. Those are push shocks in the language of Forbes and Warnick, okay? And domestic pull shocks, okay, those factors, possible factors. Our regressions are going to capture the push shocks on flows in a specific way, though. Our measure of global financial volatility, we're going to use VIX here, but we've also tried implied volatility, more specific to India, and U.S. policy interest rates, roughly, okay? Our pull factors will include real GDP growth, India's real GDP growth, domestic interest premium, that is the term premium, and the domestic policy rate. The domestic policy rate enters as a differential, the WACR, right, the weighted average call rate, as a good measure of the stance of monetary policy rather than the repo rate for India, and the Fed funds rate, okay? The term premium, of course, will also incorporate that. Okay, so this is, I'm going to look quickly at the data because this is one of the little problems that might come up, is looking at this data. You'll notice there's an enormous spike in there that looks like it's around 2010. It's October and November 2010. The capital goes in October and goes out in November. We couldn't find an explanation of why that's there, okay? We couldn't find anything in looking at the asset pricing data around around those 2 months, okay, in those 2 months. So, in fact, we looked a little further, and you can see the rest of it. There are differences between the sum of debt and equity flows and the total flows reported in the data set. Why do we use debt and equity instead of the total flows? And just, of course, dummy that out. All right. What we looked at carefully was that the difference there in their data is from an empty column called Other. Every other country, right, in which there's a discrepancy, has numbers in that column. Okay, we couldn't find that documented. So without documented data, we decided not to use it. Okay. The equation, the estimated equation that we use just looks like this. It's just a linear equation. Okay, it's what's used by others. That plus is supposed to be in line, okay? We do it lagged once, right, when we actually do it, not lagged forward longer. The quantiles we use are going to be from the 5th percentile, 10th percentile on up to the 9th. We're going to concentrate a little bit, and if I truncate my talk, I'll concentrate really strictly on the 5th and 10th, and even the 1st percentile. Standard errors are bootstrapped here, okay, which is useful to know, okay? And we use the results from those, say, 15, okay, 20 regressions, okay? We use those to form a probability distribution for predicted foreign capital inflows, okay? And those are calculated using a skewed t distribution, okay? It's a fairly recent, okay, innovation. Our covariates, right, are going to include the VIX, the term premium for India, which is the 10-year GSEC minus, right, the weighted average call rate, the India-US spread, I already defined, and the India-US real GDP growth differential. Those are our important variables. So they capture both push and pull factors, but some of them have the combination of them, so a little bit ambiguous. When we use interactions, we're going to look at how the global uncertainty, expressed as the VIX, interacts with the reserve to GDP ratio. And when we do the policy interest spread, right, we're going to interact that with the reserve to GDP ratio so that we capture that difference in relative monetary policy through relative policy rates, okay, to capture a monetary shock. The growth differential similarly. Okay. So this is what a diagram looks like for the coefficients. Oops. What do I get to push this and do? Oh yeah, good. So you can see these different pieces of it. So for example, this looks as, this is our baseline case where what we do is have an additive term of the foreign exchange reserves to GDP. This is the VIX effect, and if you see closely, you could see that an increase, right, in global financial uncertainty lowers, right, capital inflows, that is foreign capital inflows to India, pretty much across the board, okay? There's quite a bit of noise up here anyway, okay? The second one is we'll see over here, we see the India interest premium, and we'll also see there's actually a significant positive effect in that on capital inflows at high, right, percentiles. So that means at high levels of capital inflows, and these are, of course, these are conditional, right, regressions. So at those high ones, we notice that the Indian premium is giving you a boost to inflows. The India-US spread is similarly giving you a boost to inflows there as well, okay? So I'm going to skip the insignificant growth differential and focus now on our interest. Our interest is a change, an increase in reserves. And what we'll notice right here, I'm going to just concentrate on, which is down here at the low, right, percentiles. Okay, this is at the 0.05, or that is the 5th percentile and 10th percentile. Some of these goes up to the 15th percentile, is we get a positive effect of reserves on capital inflows at the lower end of the tail. The left end of the tail, capital outflows decrease, okay? We'll see there's some effects possibly elsewhere in some of the other diagrams, but not in this case. So we offer
Can I give you about a 3-minute time check?
Oh, yeah, you bet. Okay. Okay, so to finish this up is you'll notice that very pronounced effect at the lower tail. In fact, there's a substantial decrease there in capital outflows. That decrease in capital outflows, all right, I have it written down. So that decrease in capital outflows is on the order of moving you the first percentile, right, from negative 3.7 billion in a month, okay, to negative 1.3 billion. So there's a significant difference, that is, that's cutting that outflow by 2/3, okay, in that case, with the predicted estimates, okay. So moving forward to the next specification, because of my time, we're going to interact instead, okay, with global uncertainty, with the index. Okay, so I'm going to notice that when I look down here, right, at the interacted term, I'm getting the effect of an increase in reserves, and I'm getting a substantial effect of the increase in reserves at the lower percentiles. Okay, the percentiles that I'm getting them at here are down in 0.05 and 0.15. Okay, the next one I want to do is I want to look at, I'm going to skip this, that's a shock to VIX. This is that shock just per trade, that large substantial difference. I'm going to skip the differences, they're in the paper. Okay, so we get a large substantial difference here. Okay, you'll see that that's a 50% increase in mean reserves. These are simulated at the means of each variable. Okay, now I'm going to interact it with the US policy rate spread. This would be a monetary policy shock. So it could, for example, be an increase in the spread, could be monetary tightening in India relative to the US. That's, of course, consistent with monetary policy easing in the United States. Most of this effect may well be, right, the effect of, but not disentangled between the effect of episodes of tightening or loosening or easing in the United States versus in India. The thing to really highlight on here is down here is this is what that spread does. The spread itself has the effect you would expect, okay, which is an increase in that spread at low percentiles and the low quantiles, right, gives you an increasing outflow of capital. Whereas an increase in that spread, right, at the high, okay, percentiles, where you have large inflows of capital, are exacerbating those inflows. So this is destabilizing in that sense of increasing the variability, the variance of capital inflows. When I look down here and you add in reserves, additional reserves, right, contract those effects. They contract the tails in. Okay, so that's what the next simulation shows. Of course, it's bimodal, big deal. You'll notice that what we have here is a
Could I just
substantial
ask
decrease.
you to,
Yeah.
for now, just indicate, so what
Okay.
does this mean for policy? We'll come back to you later.
Okay, the gross inflows, so we get the gross debt inflows. Okay, so the next thing we do is we use equity flows. The lesson here from equity flows is you'll notice, or I'll just tell you, they're insignificant effects. So we have an effect that makes sense from a policy perspective is that we increase reserves against a monetary shock. That's stabilizing of debt flows, which are sensitive to short-term interest rates, but it's not stabilizing, has no significant effect, virtually no effect in the point estimates, on equity flows, which are sensitive more to longer-term, right, interest rates and longer-term effects. The next one that we do is the interaction with the GSEC. I'll just briefly say this, what the term premium does. You'll notice that if you look at the term premium over here, right, you'll see that the term premium, an increase in the term premium has a negative effect on capital flows. It reduces capital flows. That means a steeper yield curve for India has an adverse effect on capital inflows. It may not be what you would expect, okay, from an increase from a steeper yield curve. However, we have the mitigating effect of an increase in in reserves. An increase in reserves reduces that effect. It has, again, a stabilizing effect, but it's more pronounced. And it's also noticed that it's across here, right, all quantiles. This happens to be FPI flows. That is true for both debt and equity flows. However, if I look at debt flows alone, it's at the lower tail. The stabilizing effect of reserves are reducing extreme outflows of capital. If I look at equity flows, that's the rest of the distribution. The middle of the distribution is affected there. So again, it's a pronounced effect on debt flows at the low percentiles, at the low quantiles. Okay, quickly, the opportunity cost of reserves. We want to know what the opportunity cost of reserves responds to them. This is one of the questions about how many reserves should you have? How much do they cost at the margin? That's usually measured by the sovereign spread, the difference in returns on reserve assets, and the opportunity return to the investments forgone. That is, for example, purchasing the government debt that you sterilize with. Okay, so the cost of reserves is typically estimated, okay, by looking at those spreads, as well as carry costs, ex post costs, carry costs, and other valuation effects, for example, trading across the yield curve. Okay, so for quickly, just to skip right down here, right, is we've done a quick calculation at the bottom here of carry trade return, did it over a 10-year period using the data that I'm going to show you in a second, okay? For 1 year carry trade, good. That there's a positive return average, actually, for that period, for that 10-year period, carry trade return. That means that essentially the central bank is carrying the counter carry trade to carry trader sitting in their kitchen, the computer, okay? And what we're doing and what you're looking at is going that the RBI actually has been making a profit on that, very much unlike maybe the Australian Central Reserve Bank, okay? The 10-year interest spread, just for reference, right, over that period of time was 5.7. Why do I use that period of time? Because I have a very nice data set, okay, that we haven't augmented, okay? The idea here is to look at the difference between, you can exactly see in the graph what we're looking at the difference. The orange line is the conventional sovereign spread. The decomposition of Duane-Schreger that's used here, okay, decomposes between that red line and the blue line. The red line is the exchange rate risk, okay? The blue line would then be the pure credit risk, okay, the difference between the two. Monthly data, there's some adjustment in here for that pure credit risk because there's some missing dates. The idea here is to create, right, an equivalent to a forward contract, for example, for a 10-year bond, 5-year bond, 7-year bond, so forth. Okay, those are done in cross-currency swaps. I won't say more about that.
Ken, no, at this point we are,
Okay.
well, but the paper is there. Can we get you to respond to the discussants at the end? Or
Sure.
Yeah. I'm sorry about that, but I imposed this on the system. I've given you 5 minutes extra. So, and the sequence will be Bery, Ranil, and Poonam.
So while my slides come up, let me say that it's a pleasure to comment on this paper by Ken Kletzer, who's a professor at my undergraduate alma mater. And to Suman's great relief, I think, I'm going to be brief for 2 reasons. Number one, I'm on the panel again later this afternoon. Latha our moderator is in the room. I want to bank 3 or 4 minutes for that later discussion. So everybody heard that. And secondly, much of what I know and think about this topic comes from the work that Poonam and I have done together. So maybe this will enable us both to be relatively brief so as not to repeat one another. So can I see the slides down here too, please? Thank you. So you saw this figure already, which makes the point that reserve accumulation by emerging markets is a prominent feature of the emerging market world over the last quarter century or so, and that India is a case in point where reserves have risen quite strongly. So looking at this figure makes me ask a couple of questions. Number one, there are 80 central banks around the world at last report who, with a lag in their annual reports, report the currency composition of their foreign exchange reserves. Why not the RBI? A second question would be, shouldn't we take gold out? I mean, I was actually at a conference with reserve managers last week, and when they hold gold, when they buy gold, they buy it to hold it. They don't use it for the kind of interventions that are analyzed in this paper. Gold is clunky. It has to be vaulted below ground. It has to be insured when it's shipped. So it's a different kind of reserve. Maybe it should be removed. The authors distinguish 3 reasons for holding reserves as a buffer against capital flow reversals, to enable intervention maybe even in relatively orderly interventions in the Forex market, and for mercantilist reasons, in other words, in order to keep the exchange rate down. So my appetite had been whet. I was looking forward to finding an analysis of all 3 of these, and the analysis is mainly about the first of the 3. Reserve accumulation is not uncontroversial. We saw how India holds way more reserves than a normal country if normality is defined by the International Monetary Fund. And we know that reserves are not costless. Emerging markets holding them earn low returns on U.S. Treasuries, maybe a little less low recently, but you heard about that carry trade, that they earn less on their reserves than they pay on the debt that they issue. And Danny Roderick articulately made this point a couple of decades ago. So therefore, I wanted to find in this paper a welfare evaluation of the global costs and global benefits of holding foreign exchange reserves, and whether there is any justification for the unusually generous reserve holdings of the RBI. The authors do contribute both on the cost and benefits side. In terms of benefits, they show that reserves reduce the impact on capital flows of global shocks. In terms of costs, they show that maybe the costs are a tiny bit less than we thought before, because if you hold reserves, you can issue domestic debt at a slightly lower interest rate, and therefore the differential that you pay is somewhat more moderate. So this is a sophisticated and convincing empirical analysis. I'm broadly on board with the conclusions. I have questions. Questions about the evidence. So countries hold reserves for 3 reasons. We were reminded the authors don't really say a lot about the numbers 2 and 3. How do we quantify the benefits of foreign exchange market intervention if we want to look at number 2? How do we quantify the value of an undervalued, the worth of an undervalued exchange rate if we want to analyze number 3? So I would suggest that there actually is work that can be built on to analyze those other aspects. So I cite on the left here a paper on the real exchange rate and economic growth that suggests that historically countries that have maintained a competitively valued exchange rate, policies speak for undervalued currency, moving resources into the export sector, have done better in the medium term in terms of economic growth. And similarly, there is a substantial literature. I show you an example thereof on the right, connecting exchange rate volatility negatively to economic growth, although there are different results depending on whose econometrics you prefer. So we heard a extended justification of the author's focus on non-resident capital flows. And I've always found this kind of peculiar. I had the office next to Jeff Frankel when he wrote this paper on the Mexican financial crisis. And he famously showed, using closed-end fund data, that the domestics ran before the foreigners. So I think whether it's appropriate to focus on the non-residents depends on the circumstances. Maybe that's appropriate for India because of capital controls that constrain the ability of domestics to invest abroad. But more generally, I think this focus on non-residents as always and everywhere the source of the volatility, not a criticism of the authors as much as a criticism of the literature, may be unwarranted. Questions about the regression. So I'm not a quantile regression guy. I could have used a little more guidance, like being told what the red dashed lines were. We can imagine 2 standard error bounds here and there. I suspect that's kind of adjusted T standard error bounds. So what we're looking for is where the gray band is totally outside the 2 standard error bounds around 0. And you can see for the one that matters the most, the effect of reserves on capital flows, the only place where it's consistently outside the 2 standard error bounds around the 0 line is way on the bottom where there are big outflows. So hence we have the author's emphasis on how reserves dampen portfolio outflows in and only in the very worst states of the world. So that made me wonder about the applicability of this to India. India hasn't experienced globally the very worst states of the world. It hasn't had a massive financial crisis, a great big capital flow reversal anytime since when, 1991 or so. It's had some discomfort in the various taper tantrums. But if reserves are being held in order to insure the country against the very worst states of the world, maybe India doesn't need as many reserves as it holds because it doesn't experience those states all that often. One more minute, and then I see I.
He has 4 minutes left.
Oh, all right. See, Suman is holding me to my 3 minutes in the bank. Very good. So we see regressions like this, and we naturally wonder about reverse causality when the government is more creditworthy. Capital will flow in, leading to the accumulation by the authorities of reserves. Might we use a global interest rate shock as an instrument here to aid identification? It's a control variable in this specification. Is that better than using it as an instrument? So this is what I still am hungry to know. Is India's level of reserves too high, too low, or just right?
Okay, yeah. Bery, you were right, and you have, as they say in the hydrogen or the green hydrogen business, you have banked 3 minutes. Okay. Now we go to Ranil.
Thank you, Suman, and also thank you, Poonam and NCAER, for inviting me. I think this is quite an interesting paper in line with a lot of what the IMF does. I will clarify, actually, the IMF's use of India's reserves in my comments today. So the paper, as already Bery mentioned, focuses on the optimal level of reserves, basically looking at the precautionary motive balanced against the opportunity costs. It does mention other reasons, two other reasons, the short-term volatility issue as well as mercantilism. Short-term volatility has been a big issue for the country I was just working on, Japan, where they've been intervening to quell some of the short-term volatility in the dollar-yen over the past couple of years. There are a few other reasons for reserve accumulation or foreign exchange intervention. Those include, consistency with monetary policy objectives such as an inflation target. It could be they have a fixed exchange rate, and I'll get a little bit into some of my comments later, where FXI is foreign exchange intervention is automatic. And for some countries, there is an issue of long-term savings, especially if this is a resource-rich country, for example, and intergenerational equity. Anyway, my comments will focus on some of the policy implications from the paper, and especially how we, the IMF, addressed reserve adequacy, and more holistically, the overall external position of a country. And then how this may apply for India. I do have a few technical, but I'll share bilaterally with the authors. So to start, we at the IMF would agree that foreign reserves, importantly in conjunction with sound policies and fundamentals, can bring significant benefits by reducing the likelihood of a balance of payments crises and preserving economic and financial stability. And this is broadly in line with what the first part of the paper tries to address. And in the IMF, we also set this against the cost of holding reserves. And there are multiple ways to do that. And that's what the second part of the paper addresses. So we examined this issue regularly, definitely in our Article 4 consultations, but even in our general surveillance. And the point here I'd like to make is it's a forward-looking discussion on reserve adequacy. So though we have these various metrics, we also want to consider potential emerging external vulnerabilities. And that's also something you need to take account for in India. In that context, we also try to make a broader assessment of the country's external position, including based on IMF projections as well as the authorities' projections. And given our global role, we also need to assess that against not just the implications for our country's domestic stability, but also global stability, something that Bery touched on in his comments. So in terms of how we assess reserve adequacy, it's not as simple as been discussed so far. It depends on country characteristics and circumstances, and it can change. So a simple categorization is looking at it by development stage or income level, but I would also add here financial market development. In other words, we use different analysis for whether if a country is advanced, emerging, or low-income country. And among emerging, you can think of countries that have more advanced dynamics, dynamics more like an advanced country. And of course, there are other reasons for reserve holding other than for precautionary reasons. Examples of different methods. For example, in advanced economies, we don't really have a specific metric. We do scenario analyses. So essentially, with deep financial markets, you don't expect countries to need a lot of reserves because they have the ability to mobilize, the domestic financial sector. I think Suman mentioned at the beginning, one country that still holds a lot of reserves is Japan, and that's more, I think, a legacy issue because they do have a substantial financial market to rely on. For an emerging market like India, we typically look at what we call the Assessing Reserve Adequacy, or ARA metric. The main benefit of the ARA metric is that it is relatively simple and complete and also allows comparability across countries. The components are actually a little different than the ones the authors showed. So one is short-term debt and broad money. Those two are there. But we also look at other liabilities, namely non-resident equity, as well as medium and long-term debt. And we look at exports as opposed to imports, because exports is a potential vulnerability. The loss of export earnings is the vulnerability. The metrics shown are actually more for what we call credit-constrained countries or low-income countries, the three measures, four measures that you were showing. And the weights in our metric depend on the extent to which a country follows a fixed or floating rate regime, and that's going to matter for some of my comments on India, with relatively higher weights or needed reserves placed on other liabilities, broad money, and exports for countries with relatively fixed exchange rate regimes. And then there are other things to consider, other characteristics to consider, the openness of the capital account, whether a country is commodity intensive, whether it's dollarized, et cetera. Just on the first one, on the openness, we would place a higher relative weight on broad money if a capital account tends to be more open because of the potential for domestic flight. For emerging markets, we assess reserves broadly adequate for precautionary reasons when they range, and that's key, precautionary reasons, when they range between 100 and 150% of the metric. So my opening comment is actually the reference that the quote, India's reserves comfortably surpass IMF adequacy thresholds actually is not quite correct. So for example, in the last Article 4 staff report in this past December, we noted that at end 2022, reserves were about 106% of the ARA metric. So that's really on the lower end of what we would consider adequate. So why is this? And this gets to my comment about the exchange rate regime. So what you may have noticed over the past year is the nominal US dollar INR exchange rate has been relatively tightly managed by the RBI. So in how we classify, Ratna's and Udapir's whole department, it is actually now considered a stabilized arrangement. So we're considering India more like a fixed exchange rate regime. If you still consider India as flexible, then the statement comfortably actually holds. It'd be a little above 150%, but I wouldn't say very comfortably above, but a little above. And the reason I wouldn't say very comfortably above is you have to think of it in a forward-looking way. And the forward-looking issue is, of course, that India is now in the process, it's being included in various global bond indices, and we'll likely see increased debt inflows into India. So in a forward-looking sense, one of those measures that we look at will now grow, and therefore the need for reserves will also grow. So finally, just to end on the broader topic of potential opportunity costs, which I think Suman touched on and then also Bery touched on. If you also look at how we assess India's overall position, we believe it is moderately stronger than the level implied by medium-term fundamentals and desirable policies. In other words, we view India's current account deficit as somewhat smaller than would be implied by various things, particularly India's level of per capita income, demographic trends, development needs, and relatively favorable growth prospects. You know, India is probably the largest fast-growing economy, the fastest large economy, growing economy in the world. I didn't say that right. Anyway, we assess the current account deficit, what we call norm for India, at around 2.25% of GDP, which is consistent with the old thinking on India. India could comfortably finance a current account deficit about 2 to 3%. In recent years, it's been closer to 1%, and even in our projections, it doesn't get up to 2% current account deficit. So this gets into the broader potential opportunity costs, because the counterpart to the external current account deficit is savings less investment. And to the extent this means India may be underinvesting, there seems to be a greater scope for investment. And this gets back to Suman's initial comment about the significant investment needs for India, including for green transition. So I'll stop there.
Good. So you have also banked a minute or two. So Poonam, that's available to you, but if you are as economical, then we may have an opportunity for Ken to respond to a couple of these comments.
I will not use more than my 12 minutes.
Okay,
but
good.
I'm not giving up on my 12 minutes either. So at this point in time, I think except for the panelists, it's only Ratna and Uday who understand these issues and care about these issues. And that's the challenge of working on open economy, macro, or central banking. The outside, the RBI and perhaps Mumbai in general, there is very little interest, and there is even less expertise to work on these issues. And at the endeavor at the IPF is that we should work on issues and we should discuss the issues that matter for India. India is a very integrated economy on the financial side as well. So this issue does matter for India. And sorry for torturing you in a post-lunch session to discuss these technical issues, but bear with me. So my comments are in 5 parts, but I'll stop wherever my time runs out. So capital flows are volatile. They remain volatile. The authors have shown it. But the nature of the shock has changed, something that the paper does not recognize. Countries around the world do not face old-fashioned sudden stops, whether these are country-specific, the kind India experienced in 1991, or whether they're regional, the way Asian economies experienced in 1998. Instead, what they experience are emerging market sell-off episodes. These are the episodes that impact countries, all the emerging markets at one go. For example, 2013, 2018, 2021. These are very different elements. And the paper is a little bit, muddling through both kind of episodes. At some places, they call them sudden stops. At other places, as broader capital market volatility and insulating against them. Reserves, incidentally, and this is the work that Bery and I have done together. We were the first paper actually to analyze the taper tantrum episode of 2013. That's the time India was considered one of the 5 fragile fives. Its economy seemed to be in a free fall, as with Turkey and Brazil and a couple of other countries. And the question was, what are the kind of economies which are facing this kind of impact? So we did a very simple exercise which got a lot of traction because 2013 in a way was one of the first emerging market sell-off episodes, and the impacts were surprisingly large. And in that exercise, we realized that most of the domestic economic fundamentals, including the level of reserves, do not insulate an economy against the initial impact or the final impact by the time the shock is over. A third point that I'll allude to very briefly is that all countries hold reserves when you look at them with the right denominator. In my case, I'm showing them with percentage of GDP. India is not an outlier. India needs to hold these reserves as we do the other emerging markets because there are very few other financial safety nets. Ranil wanted to go after me as a discussant because he thought that I'll make a few comments on the IMF, which I have been doing in the last couple of years. We all become a bit of nationalist after we move back from the World Bank and the IMF, and I think it would have been better for him. IMF has been consistent in its advice, but it's not being acted upon by many countries. Maybe they do not find it particularly useful. We have Shubhashri here, who painstakingly looked at the last 20 years of Article 4 reports of the IMF on India and the advice on India's exchange rate flexibility and level of reserves. So in the last 20 years, IMF has published 17 Article 4 reports. In all of them, with a little bit of variation in the degree of forcefulness, they say that India has adequate reserves and that exchange rate should be the first, should take the biggest hit of any kind of shock, and that it's not flexible enough. And I'll show you how India's exchange rate has moved. First, a few technical comments just in a minute or two because they are important. I'm not just a discussant, I'm also an editor of this paper for the IPF volume. The two main exercises which can present it, time periods differ in the two exercises without any justification. It would be useful to provide one or to be consistent across these time periods. Across the two exercises, it would be useful to add sensitivity analysis to different episodes and different time periods. Quantitatively, the shock given, if I understand it correctly, as described in the paper, is 50% of the reserves to GDP. Are the results obtained for a smaller, more reasonable shock, the kind we usually take in papers, 1 or 2 standard deviations, etc.? Quantitatively, results seem very, very small, etc. Quantile regressions, if I understand it correctly, have been estimated with only 10 observations per quantile. Quarterly data has been transformed into monthly data by interpolating GDP series from quarterly to monthly. In my mind, it can bring spurious correlations. So let me come to the stuff that I'm more excited about. As I said, capital flows remain volatile, but the nature of the shock has changed. They have moved from being country or region-specific sudden stops to emerging market-wide, emerging market sell-off episodes. And these are the kind of episodes I'm talking about, 2013, 16, 18, and 2020. 4 episodes in a decade. So more frequent. Each one is becoming increasingly more severe in terms of the outflows of capital. And as the author showed, India's reserves to GDP ratio during this period of 10 years has been stable. And still it's impacted by each one of these. So one can do econometrics, but at one level, that level of reserve, stagnant, very little up and down on an annual basis, has still resulted in an impact of each one of these. And this is how India has been impacted by these episodes. I've singled out 3, 2013, 2018, and 2022. In each one, as I said, portfolio equity and debt flows, and separately, equity and debt flows separately have been impacted. The impact has increased over time, at least in terms of billions of dollars of withdrawals of capital flow. And again, recall the reserve cover was high during each of these episodes and more or less stable as percentage of GDP. On the other hand, so the most interesting part of the paper is how has the Reserve Bank of India handled these episodes and the volatility associated with them. In 2 of the first episodes, exchange rate overshot. The magnitude of the shock increased over time, but the impact on exchange rate has declined. It's partly because how the RBI has been managing these. In the first one, the peak depreciation of the exchange rate was 25%. In the second was 15%, and the third one, the most recent one, which perhaps led the IMF to declare India to be a currency stabilizer, is that they just let the exchange rate inch up very slowly. Now, the real question here is, are there different welfare impacts of the first two episodes? What does that volatility bring to the country, its growth rate, and how the corporate sector, handles these shocks? And if there are welfare impacts of the first two, then the third one is perfectly legitimate, right? This is how the numbers look. I've already talked about the exchange rate. 25% was the peak impact in the first one, 15% in the second one, 10% in the last one. Ultimately, exchange rate stabilized at about 10% depreciation after going through all of that song and dance drama. Change in exchange rate reserves was commensurate. In the last episode, 16% of the reserves had to be used, both in the spot market and forward market, and that's a very large number. If you think you have to spend those kinds of percentages of your reserves, you might as well hold them now. All emerging markets hold reserves. We saw absolute numbers again. Once you scale it by GDP, India is not an outlier by any means. The number is about 17% in 2022, and there are many other countries which hold similar level of reserves. And why do countries do that? Because there are very few other global financial safety nets. On the left-hand side, I have the many other possibilities that could have played the role that reserves do today, but emerging markets do not have access to them, including to the IMF's contingency lines, which exist in practice, but are not found to be useful by emerging countries. Now, this is about the IMF's advice to India being consistent during the last 20 years. In each one, it has declared that India had sufficient or excessive reserves, and that it should let the exchange rate be the main shock absorber, except during one period. Right? This was right before taper tantrum, 3-4 years. Exchange rate volatility increased a great deal, and IMF said, great, this is what you should do. There have to be welfare comparisons of which of these is better. The last one, a point that does not get discussed, but perhaps Suman would find it to be interesting. It's a point that Rakesh Mohan makes over and over again, that RBI, the central banks, they issue currency and they have to hold assets on the asset side of their balance sheet, and they hold a mix of foreign assets and domestic assets, right? If they do not hold foreign assets, they have to hold domestic assets. What would those domestic assets be? Should they hold more government paper? Should they lend directly to the corporate sector? Or it has to be something else. So here we just have how the central bank's balance sheet has evolved as percentage of GDP. It has stabilized at about 25%. Share of net foreign assets in it has stabilized at about 70%. The rest is domestic assets. So if the RBI holds fewer reserves, unless it shrinks its balance sheet, it will have to hold more domestic assets. Would that be prudent? What would be the net payoff in that case? And what kind of assets should it hold? So I'll stop there. I have a minute. So concluding remarks, I guess I don't need to make, except that emerging markets are doing things the way they are because they think it makes sense for them and because they think that IMF's advice is not particularly useful. Thank you.
Okay. Fine. So my thanks to the speakers, the presenters rather, because since we have a hard stop at 3:30, I'd wanted to get to Q&A at 3:15 and it's 3:14. So I'll take questions from the floor and then leave the last 5 minutes, not to myself, but for the panelists and speakers to respond. I see Martin, Uday, Ratna at the back behind, and Lata. Okay. So Lata will have priority over you, Ratna, if you don't mind. Okay. Martin? Should be on your table.
Oh, sorry. I may have missed something in the afternoon session. I don't necessarily pick up every sentence, but I wondered whether you commented on, or if you didn't, would comment on, to my mind, increasingly important question of the safety of reserves.
Mm-hmm. Yes.
To put it mildly, these are very uncertain assets issued by grossly irresponsible countries whose willingness to honor their commitments is increasingly in doubt, and after the events of the last week, in my view, are wholly uncertain. I'd like to know whether the government is or should be considering seriously what assets to hold, and in particular whether the liabilities of the dominant reserve issuer are worth the paper they're printed on.
Mm-hmm. Okay. I mean, perhaps somebody will respond to that. I won't speak on the part of government. I guess, Udabi next, quickly, and just as concise as Martin.
I very concise. First is on several reservations on the technical part of the paper. Many Poonam has already articulated, so I'm not repeating those, but I fully go with her in terms of her slide 2 or 3, and I'm happy to talk to the authors if they wish to talk to me afterwards on those. That's one. And then 3 quick things, very quick. First, since Asian crisis, a lot has changed in terms of emerging markets' approach towards reserves. The whole notion of how much do I need for precautionary purposes is no longer just, the burden of that is no longer just being kept on reserves in the balance sheet of the central bank. I think, Bery, with deference to you, with sort of apologies, I agree that gold must be, because gold is being used by the emerging markets in a very tactful way. And there have been a number of transactions that Russia is one, China is another one, India's just bought gold. And this is all coming because that's the way they're building up another portfolio of precaution. The second point is that, look, there is a notion of sovereign risk tolerance. That is what determines really, in the end, how much reserves is a country going to keep and for how long. And this has been one of those very elusive things on how would you define, say, India's risk tolerance, because India has a second problem. It has a policy risk tolerance problem. It doesn't, for example, its whole capital account framework needs a lot of review, reform, but one of the reasons why reserves are being built up is because it has to make up its mind what it wants to do, both on the exchange rate and the capital account. But I call that both sovereign risk tolerance as well as policy risk tolerance, 2 tolerances that determine the level. Financial stability, that's my last point, Suman. On financial stability, look, Asian crisis, frankly, systems were bust. Banks did not have any buffers, no capital. And yes, a lot had to be done to bail out the banking system or the financial system more broadly. But the whole saga over the last 16 years, since the global crisis, has build capacity. They have much more reserves, much more cushion, and there is a very big rethink going on today about the extent to which precautionary balances are needed by the state, given the fact that they have been implementing Basel III and Solvency II and all this stuff. And if you look at the balance sheets of the financial system, it's much stronger to take the first impact of outflows of volatility. So the reason that used to be there in the Asian crisis, that I have to take care of my financial system, is being reconsidered by a lot of central banks today, because they need reserves for other types of exogenous things that are coming in. So I just wanted to put this for the authors. Caveats before publication.
Okay. Well, a big change from in IPF is that these comments are not taking place. They're indeed being recorded, as far as I know. But still, that should not temper your comments on methodological dimensions, but I would suggest taking them offline. Lata, you're next.
My common sense understanding as a Reserve Bank reporter is that we started reserves after the Asian crisis purely for security, as the paper itself says, more to ensure stability against volatile inflows and outflows. But after the inflows reached a certain level, it's clearly become a means for ensuring domestic competitiveness. For instance, in 2008, 2009, the Indian rupee was about 6-7 rupees to a renminbi. Now it is 10-11 rupees, and I would assume that is dictated by the fact that our current account deficit with China is increasing. So it's not only perhaps, the goal is not only perhaps, protection against volatile flows, but there is another reason why the currency is kept depreciated, and even against specific import-export partners. The question of volatility, I understood, is when you're very comfortable, the Reserve Bank allows greater volatility to force importers and exporters to hedge. But when you're not so sure, it keeps it stable. But I have no answer at all as to this amazing stability over the last 2 years. I would be very happy if somebody could enlighten. It's just stunning stability.
Okay, Ratna next. And then I think I'm going to go straight to the panel. I do think we have time for another round of questions. Ratna?
Okay, just very quickly, unlike Udaybir, I'm going to defend the authors.
Like or unlike?
Unlike.
I didn't say authors are wrong.
No, anyway, unlike you and, okay. Anyway, so Poonam, this is to your point about making a distinction between sudden stop and just outflows, right? The point about this particular exercise is all it does is tell you what is the probability that there will be outflows. It's a distribution story. And what you don't know, so I like the result which says, look, the probability that the outflows are going to be lower is all that they're saying. They're not saying anything more. So when you say that there are still outflows, even though they have high reserves, you don't know what the counterfactual is. And what this exercise does is using the empirics of the past, predict for you what at the two ends, the outflows and inflows will be. And even more precisely, what the probability, what the risk is. That's all. That's all it does. So that was the defense. Just to answer, try to answer a question which the IMF has tried very hard, Martin. When I was there, and I can speak a little more freely now because I'm no longer there, about the US dollar. The problem with the US dollar is it hugely dominates the financial flows pay. It also dominates the trade flows, but the financial flows, unbelievably so. And when you look at what has happened over time in terms of the holdings of reserves of central banks, of EMs, etc., they have been diversifying. It's, the Saudis have done it, the Chinese have done it, I'm not sure about the Indians, they probably have. But there is no system or no enough volume in the world of other assets at all. You can't hold the renminbi. They have huge capital controls, right? But I completely take your point about the political risk. Living in the US, I worry, should I diversify my own assets?
Okay.
Which is all concentrated in the US.
So it seems to me we should at least recognize the problem.
But it'll be a problem in 20 years. It's not a problem today.
Right. First to the speakers, and then to the Ken.
Okay, let me. Yeah. Bery raised several questions. One of those is one that I would have addressed with the last slide, but the more or less. The problem we faced is we didn't really feel comfortable giving a bottom line, and that possibly was the task given to us, because the question was about optimal reserves, and Poonam asked about whether too large, too small. I think that's that's an interesting exercise. It's a good comment, and I think it's something that's very difficult to address. The other thing that I want to just note is where I stopped talking.
I was stopped.
I was stopped talking. Bery noted that we had relatively small effects on the spreads. Actually, what you might see, the point estimate is gives you 3 basis points for a 1% increase in reserves. So that means you have a marginal cost of 3 percentage points less than the percentage spread. So it's a difference about marginal cost, not about the spread, and that's our point, right? Which is that you have to look at the marginal cost of reserves at the margin. The other quick question: red dashed lines are slightly different. Yes, we'll define them. Those come from the linear regression, a mean regression, and they're the 95% confidence intervals for an estimate that is not a quantile regression. The Reserves, what's interesting though, and I think the most interesting comment there is the observation that we have the effects of reserves in the worst states. That was the focus on the precautionary motive, but it is not the same as asking the question, what are the benefits of reserves at the margin, right? And I think that's a good point, is that's getting at really just, we're just focusing about do they raise capital inflows, that is reduce outflows in the worst capital outflow states, as Ratna pointed out very clearly again, versus what are the benefits of reserves. So that's a good point, whether reserves are crowding in additional investment. Another thing we overlooked is, of course, we didn't include FDI, whether there's an effect of the reserve stock on FDI. Turning to the IMF,
Before you leave this, do you accept Barry's point about domestic agents or, needing to be included in this?
I'm not quite sure exactly how to do that. Do you have an idea about that?
No, I think what Barry was citing was...
Capital, okay, I should, yes, sorry.
Yeah.
I didn't write it down. I thought we addressed that in it because I thought Bery addressed it himself, which is that we don't include, as we noted, we didn't include it because domestic, that is the domestic capital outflows, right, what they would be in the gross flows, is that first they're more than an order of magnitude smaller. One of the reasons they're smaller appears, at least one of the reasons, the predominant reason you might say, is there are restrictions still on capital outflows. When you look at capital outflows, then themselves you're getting relatively small effects. We wanted to concentrate on the large effects. A complete analysis would say look at those as well, right? But that would be, we could do that, and we'd leave it in the appendix because it's not the kind of magnitude that I think we'd want to look at. But of course, if I were looking at Brazil or anywhere in Latin America, I would be paying a lot of attention to the possibility of capital flight and retrenchment. I should observe that actually the one place you do see in looking at, we did look at them, and the one place that is interesting that you see is there is retrenchment. Funds come home in the taper tantrum. But for example, in the Fed tightenings, right, in 18 and 21, 22, you don't see that. You see, in fact, the opposite. There's more likely to be some flight.
Chetan, any quick points?
Yeah, so on the exogenity issue, I agree that lagging it is just a partial way of doing it, of correcting for endogeneity. What I think Ratna does in her paper with Gaston is that they actually have a policy measure and they regress it on the previous value of the variable plus a bunch of controls, calculate the residuals and put it in and do it. We tried to do that, but we weren't getting anything too robust with that. So the correction by lagging it is a partial correction. On taking gold out, we can try that. As I said in my the original slide, gold plus SDR plus the tranche is about 11.5% as of March 2024, and it probably hovers around that range across the samples. So if we adjusted the sample, I think you would be adjusting the values, but I don't know if you'd be adjusting the variation so much, but we could definitely take a look at that. But on the question about why the forward premium on the exchange rate are so low, it's partly, this is Lata's question, both the US and India are in a tightening cycle, and I think the gaps between both interest rates are low to give you a predicted forward exchange rate that is roughly stable. Central banks, I think here, when they talk about interventions to minimize volatility, they can always hedge against these kinds of movements, right? But I think the real motivation for intervening is to correct any misalignment in the exchange rate. And that's true of, I think that's also true of the Reserve Bank of India. But I appreciate the variation in opinion. I think Barry's saying that, we may have too many reserves, and Ranil is saying based on the ARA metric, we have too little, based on whether you condition on whether you consider India having a fixed exchange rate or a flexible exchange rate. And what we're saying is, I think Ratna has summarized this properly, is that we're calculating probabilities of capital flight at risk, especially at the tails. And an interesting exercise would be to replace reserves with some proxy for macroprudential policy and then capital controls. and see whether introducing those as opposed to reserves have the same effects on some of these tail risks that we document in this paper.
Okay, we're into extra time, but since Ranil was out of sequence, I'm going to do Ranil, Bery, and end with Poonam. And I give up my concluding remarks. Mm-hmm.
Sure. So I'll just, one comment, referring to one of Poonam's criticisms of the IMF. She seemed to have many, and I anticipated that. It is not actually correct to say that emerging markets don't have access to IMF contingent credit lines. In fact, they do. The issue is not that, it's why Asian economies, not just India, why Asian economies do not access them. Latin America, 5, 6 have accessed IMF contingent credit lines. I mean, Colombia, Mexico, Peru, Chile, I can go. Poland has, Morocco has, but Asia has not. And I think this is still a legacy of 25 years ago, which is the Asian financial crisis. And unfortunately, that stigma remains. I'll stop there.
On Martin's question, my co-authors and I have looked at the impact of sanctions passed, imposed by the US, by the UK, by Europe, by Japan, on the currency composition and level of foreign reserves. We find no impact on the currency composition or level, and we find a modest positive effect on the demand for gold by central banks. We find no evidence that the dollar's exorbitant privilege has been damaged by past US recourse to sanctions. You could say this time is different, of course, but I would observe that the dollar's exorbitant privilege survived 4 years of Donald Trump intact.
20 seconds. Ranil, please don't take it personally. We will be together in Delhi for 3 years. And I'll keep repeating and updating these points. Ratna, again, not something serious. I think you're defending your own work that they have cited and based their own paper on, and we can discuss offline.
It's fine to defend one's own work. So we very much talked about the world as it is, whether, I think Michel Condessou fronting the, what was it, the Palais Royal group, talked about we had a chance. You know, the world monetary system is a non-system. It is not delivering the kind of stability or security that would evoke or support the investment boom that everybody thinks that the world economy needs. India, if it becomes the third largest economy at market prices by the end of this decade, which is the aspiration of the PM, and unless something very dramatic happens, it needs, I think, to appreciate what are some of the responsibilities that come with that. And indeed, as Poonam argued, I mean, I don't think we have, outside the RBI and to some extent the DEA, much internal debate about what India wants from the global monetary system. And I think that if this paper and the IPF and the discussions we've been having with Poonam, Bery, and I think what Udaybeer is here to try and think about, that, look, I mean, the modern world is built on finance. And where we want to go in terms of development does crucially depend on domestic finance, global finance, how they look. And so I think that how they are linked. And so I think that that is the larger agenda that this paper opens up. But I think, as is appropriate for an IPF paper, it takes a limited agenda and throws a lot of technique at it. And that is, in a sense, I think, what, that's the tradition we want to nurture and cultivate. So thanks for the opportunity, Poonam. Thank you for accommodating the changes. And at this point, 5 minutes late, I'll take my leave. But I hope to be back for the panel at the end. Thank you all.